Shares of ChargePoint hit an all-time low on Friday, and the question now is whether or not the company can recover. Obviously, losses are mounting at ChargePoint, and the company is really in a tough financial position because it needs to raise money to fund those losses. And now we have news that Tesla is laying off workers, and it seems like electric vehicle demand just isn't what we thought it was going to be even just a couple of years ago. So I want to dig into exactly what we know from the numbers and how to think about ChargePoint stock in 2024. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to the stock chart first, because I think the fall in shares is really astounding. You can see this one-year chart shows ChargePoint stock down 85%. But if you back out to when the company came public, remember this was a SPAC merger, so that SPAC was trading at about $10 per share, jumped all the way to over $40 per share, over $45 per share for a period of time. But then it's just been a steady collapse ever since then and continues to drop, hit $1.34 per share today. The problem for ChargePoint is the business model and what the company actually makes and sells. They like to talk about how they're making SaaS products or charging as a service, but at the end of the day, most of their revenue is right over here. It's in the actual physical charger itself. And it's selling those chargers at a loss, especially when you consider the amount of sales and marketing that goes into each one of these sales. Now, the idea in theory was that you sell a piece of hardware up front and you're going to make money on the back end as people charge it, whether it's through the ChargePoint fleet or whether it's through subscriptions that they're selling to people like commercial customers. But that hasn't happened. Now, I want to just start with some of the high level numbers because this is really hard to get past. ChargePoint is losing almost as much money on a net income basis as it's generating in revenue. That's extremely hard to do for a company that's generating $500 million in revenue. If you look at their free cash flow, one of the ways to judge the health of a company is the company's cash flow. And oftentimes we look at free cash flow. So free cash flow is going to be cash from operations minus the capital expenditures that it actually takes to keep reinvesting in the business. But with ChargePoint, you can just look at the cash from operations, negative $330 million in the past year in negative cash from operations. This is a company that now has a market cap of $584 million. So just a terrible set of operating metrics for the company. And there's just no way to like this company from the operations alone. And then you start to look at the balance sheet and you have not only a fairly weak cash position of $327 million in cash on the balance sheet. So that's going to be only about a year's worth of cash to operate the business. But there's also $284 million worth of debt. So this is the kind of financial problems that ChargePoint is in right now. And the macro environment surrounding ChargePoint, surrounding the electric vehicle business, just isn't getting better anytime soon. And at the end of the day, that's why the stock is dropping recently. And as the stock drops, the options for the company are going to dry up. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So we've already gone through the company's operations, how it's losing money, how the balance sheet doesn't look very good. But I think the core problem that we need to go back to is what value is ChargePoint bringing to the industry? What are they actually doing that somebody else can't do? They're making an electric vehicle charger. That's great. But if you can't sell an electric vehicle charger for a profit, then what kind of a business do you have? And the idea of adding some sort of ongoing revenue like SaaS or like selling electricity through chargers is a really good idea, but it's never been proven in the market. And so you at least need to be profitable in that hardware that you're physically installing. And ChargePoint can't even do that. The other problem that I think we're running into, especially in North America, is charging has been standardized. Most vehicles, especially going forward, starting in 2024, 2025, are going to be on the North American charging standard, the Tesla standard. That means that every plug is going to work with every charger, and what you're putting through that plug is electricity. So you have a commodity that you're delivering, electricity, going through a commodity or a standardized plug. What difference does it make whether you're charging with a ChargePoint charger or a Tesla charger or another off-brand charger. It just doesn't make any difference. And this is where there's a fundamental problem with a lot of these charging companies. There's just no pricing power in the market. And so when they had valuations that were in the billions of dollars, sometimes tens of billions of dollars, that's where I just ask questions about what in the world is this business going to look like going forward. Now these valuations have dropped, but now we're getting to the reality where the electric vehicle market, the fundamental growth market that these companies were going to be serving, doesn't appear to be growing in the way that a lot of investors thought it would. Tesla announced this week that they were going to lay off 10% of their staff. That was after a really disappointing first quarter delivery number where they actually delivered, I believe it was 40 or 50,000 fewer vehicles in the first quarter of 2024 than they did in 2023. So demand, at least for Tesla, is on the decline despite the fact that prices are on the decline as well. At the same time, you have more and more competitors going into the market. They're having to compete on price. I think we're going to see electric vehicles overall grow, but maybe they're not going to grow 50, 60% a year. Maybe they're going to grow 10 or 15% a year. That would be great in a lot of markets, but it's not great in a market where you're counting on massive growth for the industry overall. And that's where ChargePoint was at. That's the way it was positioning itself, was that there was going to be some major profit center at the end of this electric vehicle growth curve. And it doesn't appear that the electric vehicle growth curve is going to be as attractive as we thought, and the business is not proving to be as attractive as we thought as it is scaled. So all fundamental challenges. And now as the stock price drops, you get to the final challenge, and that is how in the world are you going to finance this business long term? I talked earlier about how ChargePoint is burning through hundreds of millions of dollars, and it has $280 million worth of debt that it's eventually going to have to repay. As that stock price drops, it makes it harder to raise capital by selling more stock because you're going to dilute shareholders even more. So that's not all that attractive. You already have debt outstanding. So if you want to issue more debt, that's going to be at a very, very high interest rate. Those markets may not even be open at all. So you get to the point where you're between a rock and a hard place. You're going to burn through all of the cash you have on the balance sheet. And then if you can't raise more, there's no option but to restructure the company or go through bankruptcy. I don't think we're there yet, but it's definitely on the horizon for ChargePoint. So as a result, I don't think that ChargePoint is the kind of company that you can invest in today and expect any kind of return. I would put Blink Charging in this same category and all the other charging network companies. This is just not proven to be a profitable business. Selling a commodity that's delivering a commodity through a commodity plug is just not a good way to generate value long term. I think chargers are going to be everywhere, but they're going to be subsidized by all kinds of other things, like retailers wanting to attract customers who have electric vehicles, offer free charging to come shop at our store, or the same thing for restaurants or offices. But building a charging network and selling chargers themselves has not proven to be a good business. And now as ChargePoint stock hits an all-time low, it's going to be even harder and harder to finance these losses long-term. And fundamentally, that's the problem. That's what's going to keep pushing shares lower. And I just don't see a bright future for this company or shareholders at all. We've seen this story happen before, and it doesn't end well. What do you think about ChargePoint? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.